I want to consider the possible impact that tariffs might have on the diamond market. There's a lot of confusion in the trade about it. It's quite nuanced, and there are several ways the industry may be affected and several factors that one needs to consider. Now, if you've been hiding under a rock and are unaware, just to update you, US President Donald Trump announced on April 2nd a 10% hike on duties of most products imported from most countries to the United States. He also announced higher reciprocal tariffs on several countries, which was scheduled to take effect on April 9th. At the last minute, President Trump paused the reciprocal tariffs for 90 days, which brought a collective sigh of relief to the diamond and jewelry trade, equally felt in Surat, Antwerp, Ramat Gan, and Gaborone, among its many other centers, which all face different reciprocal tariff rates. But the industry is subject to that 10% rate hike. To understand their impact, we look at the short-term and long-term effect, and we also break it down into the different stages of the tariff implementation. How did the industry view the tariffs pre-April 2nd? What happened during that week of April 2nd to April 9th when the reciprocal tariffs were on the cards? What's this current scenario? And what happens after the 90-day grace period? Pre-April 2nd, all the tariff talk centered around other industries, and the expectation the diamond and jewelry trade would be directly affected was marginal. The primary concern at that point was the impact that the tariffs would have on US consumer confidence. A rise in the import costs on products such as aluminum, iron ore, and steel affects import costs on everyday items, cutting into household budgets for discretionary items. And I want to keep that in mind because amid all the confusion about what will happen, the most important consideration remains how all of this will affect consumer spending on diamond jewelry in the United States. We must keep that in mind as we assess the impact of the 10% tariffs that took effect on April 2nd, both at the wholesale level and at retail. But ultimately, it's retail demand, consumer spending on diamond jewelry that matters most, especially considering the size and influence of the US market. Remember, the United States accounts for just over half of global demand for diamond jewelry. The industry depends heavily on the American consumer. Now, we do need to consider what happened in that period between April 2nd and April 9th, ahead of the now paused higher reciprocal tariffs, even if they didn't go into effect, because they have affected this current scenario in the industry. So what was on the table exactly? Higher reciprocal tariffs on pretty much all products targeting several countries, including some of the major suppliers of diamonds and diamond jewelry. Among those, India, the main supplier of polished diamonds to the United States, was to be subject to a 27% tariff, the European Union 20%, Switzerland 31%, China at the time 34%, and Israel a 17% additional fee. Among the beneficiation centers, Botswana would absorb a 38% duty, South Africa 30%, Namibia 21%, Angola 32%, and Lesotho 50%. And that would be applied to both rough and polished diamonds. So there was a massive relief when those reciprocal tariffs were frozen, as it meant that the industry would maintain a level playing field in supplying its largest customer, the United States. We no longer faced a scenario in which goods from India had one price, Botswana another, Dubai another, and Israel yet another, etc. During that week, though, when the reciprocal tariffs were still on the cards, we saw a rush to move goods to the United States, and wholesale polish prices rose as dealers baked in the expected increase in import costs. The diamond industry has been trying to raise polished wholesale prices for the longest time. It's been an uphill battle. So isn't this a good thing? The value of diamonds has come down in the past 2 years, and so shouldn't we welcome the increase in value? Well, it depends on what influenced the rise in prices. Prices rise for various reasons, but I think there are three main ones. In Economics 101, you have the supply and demand curve, and price is set where those two intersect. So prices rise due to an increase in demand, which is the best case scenario, or where there is a shortage of supply. And the opposite is true in affecting a decline in prices, resulting in a drop in demand or an oversupply of goods, or as one leads to the other. And then the third scenario is when costs rise. For example, when rough prices increase, manufacturers might respond by adjusting their polished prices upward. And that's kind of what happened in April. Prices increased not because of a rise in demand or a supply shortage, but due to a rise in costs, or an anticipated rise in costs. When costs rise, suppliers raise their prices to protect their margins, and that's what happened. But our concern at the wholesale level is whether those new price levels are sustainable if the supply-demand dynamic didn't change. And that brings us back to our old challenge of raising consumer demand. Whether the new price levels hold or not will depend on demand at the retail level. If we don't stimulate demand, prices will come under pressure again, and this time while the trade navigates higher costs, meaning that their profit margins will be squeezed further. And stimulating demand will be extra challenging in 2025 given the US trade policy. In the short term at least, I expect tariffs will stoke inflation while ongoing uncertainty fuels caution among consumers and businesses alike. The broader concern is the rising cost of living. We're likely to see savings as a percentage of income shrink, which leaves households with less to spend on discretionary items like jewelry. There is a likelihood that jewelers will adjust their prices to reflect the increase in their costs, but the bigger impact is that overall retail spending is expected to come under pressure, particularly among the middle and lower income segments, which were already shifting to lower price points. So I think we'll see a continuation of what we saw last year with a bifurcation of the market toward the high end on the one hand and toward lower price points on the other, leaving middle market jewelers feeling the squeeze more than most. That's not to say that the tariffs are inherently bad. There may be longer term benefits. They could boost US manufacturing, encourage consumers to buy local, and potentially generate more government revenue to help reduce the national debt and enable the government to lower taxes, as President Trump and his proponents argue. They are also intended to create leverage in trade negotiations, potentially leading to lower tariffs on US exports and recalibrating global trade relationships. In the diamond industry specifically, these shifts may nudge India to finally remove its 5% duty on polished imports to that country. That's a change the Indian trade has long advocated for. Doing so would allow Mumbai and Surat to grow as diamond trading hubs, opening India's expanding domestic market to more global suppliers. The tariffs are not going to revive US diamond manufacturing though, which is somewhat of a pity given its long-standing traditions and legacy. India will maintain its dominance in diamond manufacturing, and companies will continue to be incentivized to manufacture in beneficiation centers in Southern Africa in particular. One benefit for the trade may be that we'll see a boom in the secondary market. As one viewer commented on my last video, the US has an underestimated supply from its recycled diamonds. That's people selling their diamonds and gold jewelry to pawn shops, and those goods making their way to the trade where the diamonds are often recut to suit the market's needs, and that recutting is typically done in the United States. That's where US diamond manufacturing has shifted its focus toward. Another aspect to watch is the impact the tariffs will have on memo supply. Jewelers have increased the inventory they take on consignment over the years, and it's a way for suppliers to at least get their goods out there onto the shelf and in front of the consumer when their inventory is bloated, giving their goods a better chance of being sold. As far as I understand, memo goods are subject to the tariffs, so I'd expect that avenue of supply to be reduced. As a side note, the lab-grown market is more vulnerable to this as a very high proportion of synthetics is supplied on memo. Now, we cannot have this discussion without considering the impact of the USChina Trade War that has effectively broken out. US tariffs on China and those of China on American goods have increased some 120% or more respectively. Here again, the bigger impact is on sentiment. While China does engage in diamond polishing, it is mostly for the local market though, or to supply the wider Asian market. Its jewelry manufacturing perhaps has a broader scope. But China is still not a primary supplier of finished jewelry to the United States. Here again, India dominates. France, Italy, Thailand are other large suppliers. The Hong Kong diamond and jewelry trade may well feel the pinch more, having exported some $2.3 billion worth of polished diamonds to the United States in 2024. The US was Hong Kong's biggest market last year. But Hong Kong is predominantly a re-exporter of goods, meaning the goods are subject to tariffs of the source country as far as I understand. And China is only the 5th largest exporter of polished diamonds into Hong Kong, behind India, the United States, the UAE and Belgium. It's interesting, the US seems to be more of a supplier of polished to Greater China, but that needs some fact checking and a greater analysis. At the end of the day though, our biggest concern is back to the American consumer. That's who the industry will be watching most closely as all this plays out. So there are these nuances in the trade, but when we think about the bigger picture, it doesn't actually change our conversation. And that is my main point here. Before the tariffs, during and after, the single most important challenge facing the diamond and jewelry industry is to stimulate demand for natural diamonds. There's no doubt the tariffs change our outlook for 2025. We're already dealing with the threat of synthetics and the drop in Chinese demand, and this adds a significant drag on the market, as I think we can expect a slowdown in US consumer demand this year. But markets go down and they come up again, and we've faced challenges before. And we should not let the tariff issue distract us from the greater task at hand, and that is to play the long game, to ensure that natural diamonds are front and center of the consumer mindset when they're ready to spend again. In summary, my main considerations in this whole tariff debate for the diamond industry are A, that polished prices may have increased, but it's really about midstream margins moving forward, and those I think we can expect to come under pressure. B, the tariffs may be a net positive for the secondary diamond market in the United States. At the same time, memo supply will likely decrease. And finally, and most importantly, it's all about the American consumer at the end of the day. And therefore, this should not change the ultimate task set out for the diamond industry to stimulate demand, maybe even with greater urgency than before. Let me know what you think. How are you navigating this volatile environment? What aspects of the tariff impact are you most concerned about? Leave a comment, and don't forget to show your support with a like of this video, subscribe to my channel, and check out more insights about the diamond industry on thediamondpress.com. I'm Avi Kravitz. Thank you for watching. I'll see you guys next time.